Hello, welcome to this question from AQA A-Level Accounting, and it's a June 2013 paper, and it's Unit 1, and it's question 3. So this question is all about preparing an income statement and a statement of financial position for a sole trader. So let's go through the information in the question. We've got Sam Brady sells sports equipment, and the following balances have been extracted from his books of account at the 31st of March 2013. So bad debts written off, also known as irrecoverable debts, is £100. Bank loan, £2,450. Bank overdraft, £1,860. Capital, £11,060. Carriage outwards, £390. Discounts received, £540. Drawings, £29,930. General expenses, £5,260. Inventory at the 1st of April 2012, so that's the opening inventory, £26,100. Motor expenses, £4,310. Equipment, the cost at the 1st of April 2012, £18,200, that's the cost at the beginning of the year. And the equipment depreciation provision at the 1st of April 2012 was £7,280. Again, that's at the start of the year. Purchases, £119,130. Rent and rates, £28,900. Returns inwards, £340. Revenue, £234,520. Trade payables, £26,790. Trade receivables, £8,940. And wages and salaries, £42,890. There's quite a lot of items there. Now, additional information, we've got 9 points in total. Let's quickly go through them and then we'll use them when we need to. So point 1, inventory at the 31st of March 2013 was valued at £24,600. So the 31st of March 2013 has the end of the year, so that's your closing inventory. Point 2, an item of equipment purchased on the 1st of April 2012 for £1,200 has incorrectly been included in general expenses. Right, we'll come back to that in a little while when we're doing the income statement and statement of financial position. Point 3, the equipment is to be depreciated over 10 years using the straight line method, and the estimated residual value of all the equipment is £400. Point 4, the annual rent payable on the business premises is £19,920, and 2 months have been paid in advance at the 31st of March 2013. Remember, the 31st of March 2013 is the end of our year. Rates of £3,240 have been paid for the 6 months ending the 31st of July 2013. A bad debt, also known as an irrecoverable debt, of £580 is to be written off at the 31st of March 2013. So it's not been taken into account in the figures above, that means that. One half of the bank loan is repayable in the year ending the 31st of March 2014, and the remainder is due for repayment after that date. Sam introduced £2,000 into the business bank account from his personal savings on the 31st of March 2013. That has not yet been entered in the records, and a cheque for £410 received from a credit customer has not yet been entered in the books of account. So, Part A, prepare an income statement for Sam Brady for the year ended the 31st of March 2013, and you're given the heading, Sam Brady, income statement for the year ended the 31st of March 2013, and the rest of it you need to be able to produce yourselves. Now, to save time in this video, I'll put down all of the various categories here, starting with revenue at the top, going all the way down to our profit for the year at the end. Right, so the revenue then. I can get the revenue by looking at my initial list of balances. There's nothing in points 1 to 9 about revenue, so the revenue goes to my list of balances, and it is 234520. So 234520, 234,520. But returns inwards, again, back to my list of balances, there's nothing additional information about that. So returns inwards, I've got returns inwards here, £340. So my net revenue is going to be the 234,520. Take away the £340, it's going to give me net revenue of £234,180. Right, now some people will be asking, why do I have 2 columns or 3 columns? I've got 2 columns here. I would have 3 columns if I've got like carriage inwards and purchase returns. I've got no purchase returns, no carriage inwards, so it's just 2 columns. Right, my cost of sales next went opening inventory. And opening inventory, that was the figure in our list of balances at the beginning. So opening inventory is inventory at the 1st of April 2012, and it's 26,100. So that's my opening inventory. Purchases, there's nothing to do with purchases in the information. So purchase figure will be from my list of balances. So purchases, Here I have 119,130. Now you add your opening entry and your purchase together, and you get 145,230. Now your closing entry was in the information in the question. So the additional information, so you can take away closing inventory, and I think it was 0.1. Inventory at the 31st of March 2013 was valued at £24,600. Take away £24,600, and that then is going to give me my cost of sales, which will be the 145,230. Take away the 24,600, give me £120,630. So next we have gross profit. Now your gross profit is your net revenue, take away your cost of sales. So it's the £234,180, take away the £120,630, it's going to give us £113,550. Right, add income. Is there any other income in the question? So if you go to your list of balances, you'll find the only other income in the question is discounts received. And discounts received are £540. Discounts received is going to be £540. See Daisy. You add it onto your gross profit, and we get a total which has no name. So it's basically your gross profit plus other income is £114,090. Right, now less expenses. So my expenses, I've gone to my list of balances and I work my way through. The first expense is bad debts written off or irrecoverable debts of £100. Now, if you notice in the information, go all the way down to 0.6. We've got another bad debt, which has not yet been written off, but it has been written off at the 31st of March 2013 of £580. So our bad debts will be the initial £100 plus the 580. Now you want to show this in your workings. So it's £100, the initial amount, and plus information underneath the list of balances. So that's going to give me a total then for bad debts or irrecoverable debts of £680. Now carriage outwards, there's nothing in the additional information for that, so I go straight to my list of balances. So carriage outwards, it should be near the top. It's the next expense, going down, which is here, which is £390. So carriage outwards is £390. General expenses, right? General expenses. There was something general expenses in the additional information. So let's see what it says in the additional information. Point 2. An item of equipment purchased on the 1st of April 2012 for £1,200 has been incorrectly included in general expenses. That means we need to take it out of general expenses. So let's see our figure in the list of balance of general expenses. So it's 5,260. Take away 1,200. So it's 5,260. Take away was 1,200. Let me just check that it's the 1,200. So 1,200, that's correct. So for general expenses then, it's going to equal 5,260, take away 1,200, and we get 4,060 for general expenses. Right, motor expenses, there was no additional information about them, so it's straight to our list of balances. So motor expenses would have been my next one on the list. Here we go, 4,310. That's my motor expenses. Now rent and rates, so they're combined together. Now go back to the additional information, there's quite a bit on rent and rates, so let's see what we had. Okay, we've got 2 points. Point 4, the annual rent payable on the business premises is £19,920. 2 months have been paid in advance at the 31st of March 2013. And then point 5, rates of £3,140 have been paid for the 6 months ending the 31st of March 2013. So both of them have paid money in advance. So I'm going to show a separate working out for these. So let's go down to my workings out to show you what I've done. So my annual amount was, if we go back to the information, my annual amount for rent was £19,920. So £19,920. Now 2 months are paid in advance. So we want to work out the prepayment. So we take the 19,920, you divide by 12 to get 1 month, and then we've got 2 months paid in advance, you times by 2. So we do that calculation in, get 19,920 times 2 divided by 12, which gives us a prepayment then of £3,320. Now, so that's the rent prepayment. So what we're going to do with it, we'll see in a moment. Now, the rates, which was 0.5, or £3,240, have been paid for the 6 months ending 31st of July 2013. So let me put down the amount first, £3,240. Now, it's for a 6 months period to the 31st of July 2013. Our year ends the 31st of March 2013. So it's been paid for a few months after March 2013. And the months are April, May, June, and July. So that means there's a prepayment there of 4 months. Prepayment of 4 months. So to work out the prepayment, again, you take the amount paid, $3,240. It was for a 6 month period, so you divide by 6 for 1 month. And to get 4 months, you times it by 4. So you have 3,240 times by 4 divided by 6. So we have a prepayment of £2,160. So our rental rates figure in, we go to our list of balances. We have £28,900. So we're going to start off with £28,900. £28,900. We had a prepayment of rent of $3,320, and the prepayment of rates, which basically was the $2,160 we just worked out. So our rent and rate figure is going to be $28,900, take away $3,320, then take away $2,160. So we've got a rent and rates figure for £23,420, and that's the figure going to go into our income statement now. So 23,420. Okay. Right, wages and salaries, there was nothing in the additional information for them. So I go straight to my list of balances for wages and salaries. Right at the bottom is £42,890. Now, depreciation, it gave us some information about equipment in the additional information. So back to the additional information and see what we got. In point 2, we had an item of equipment purchased on the 1st of April 2012, the beginning of our financial year, for £1,200 has been incorrectly included in general expenses. So what that is telling me, if I go back to my list of balances, for my cost of equipment, it's not £18,200. I need to add on another £1,200. So I'll show you that in my works in a minute. Then it's going to be depreciated over 10 years using the straight line method. And the estimated residual value of all equipment is £400. Right, let's go down to my workings now. So the depreciation is your cost, take away residual value over the number of years. Now the cost, it was, in the list of balances, it was £18,200, £18,200. So I'm showing the examiner everything that they want to see. So it's going to be 18,200 and plus the amount that was included in general expenses incorrectly, which was 1,200. So that's your cost. Now you've got to take away your residual value. So back to the information for residual value. The residual value was, here we go, 0.3, £400, and the number of years was 10. So it's £400 residual value. And the number of years was 10. So that works out to be 18,200 plus 1,200, take away 400, which gives us 19,000. Now, the number of years there should be 10, not 100. So divide by the number of years of 10, And 19,000 divided by 10 is going to give us £1,900 depreciation. So that's the figure that goes on our income statement, £1,900. So now what we'll do is we've got to total the expenses now. So our total of expenses should come to 77,650. So our profit for the year then is going to be 114,090. Take away the 77,650 expenses, giving us a profit for the year of £36,440. That's our income statement. Now, in part B, it says prepare a statement of financial position for Sam Brady at the 31st of March 2013. And again, to save some time in the video, I'll put the layout for us. But again, in the exam, you'll have to do that yourself. Right, okay, so we start with non-current assets. So you've got cost, accumulated depreciation, and carrying amount. Now, carrying amount is sometimes put in the exam net book value. So the cost of the equipment, well, we know the cost of the equipment. It was the 18,200 plus 1,200, which is 19,400. So the cost of our equipment was 19,400. Now, the accumulated depreciation, that is the depreciation in the list of balances. Right at the top, it was 7,280. Then we add on the depreciation from the income statement for the year of 1,900. And that comes to £9,180. The carrying amount is your cost of 19,400. Take away your accumulated depreciation of 9,180 to give you £10,220. Now, the cost and accumulated depreciation we can underline because we're not going to use them anymore. Right, inventory. The inventory is your closing inventory. Now, the closing inventory, that was given to us in the list of balances. Sorry, not list of balances, the additional information. We've already used it in an income statement. It was 24,600. So that's our closing inventory. Now, trade receivables. There was information about trade receivables and bad debts. Right, trade receivables. What was it in the list of balances? We're not starting off with. List of balances was 8,940. So I've got 8,940 in my list of balances. Let me put down my workings. So 8,940. I'm going to check that figure, 8,940. That's right. Now, point 6. It says a bad debt of £580 has been written off at the 31st of March 2013. So that money's not going to be coming from the customer. So we've got to take away the £580. So back down here. I'm going to take away £580. We're not going to receive that money. And also, it says something, I think it was in the last point. A cheque for £410 received from a credit customer has not yet been entered in the books of accounts. So if we enter it, it's going to reduce our trade receivables. So we're going to take away another £410. So what's that going to give us? It's going to give us 8,940, take away 580, take away 410 to give us £7,950. Now, prepayment of expenses just comes from our workings above. It was on rent and rates. So let's go back to see what we had for rent. So rent was 3,320 and rates was 2,160. So 3,320 is the first figure. And plus the rates figure, so let's just check the rates figure, was 2,160, that figure there, 2,160. So my prepayments then are going to be 3,320 plus 2,160, giving me a total of 5,480. Now the bank, quite a few things are going to happen with the bank. So let's see what we started off with in the bank. So go to my list of balances. Now my bank account was overdrawn at the beginning of £1,860. Then you go to point 8. Sam introduced £2,000 into the business bank account for his personal savings on the 1st of March 2017. This has not yet been entered in the accounts. So that's going to turn the bank account into an asset because we've got money in the bank account now. So it's going to be plus £2,000. And then we've got a cheque from a customer for £410. We've got to add on that cheque as well. So go down to here and just let me tidy this up now. And then we'll see how much money we're now going to have in the bank account. So it's overdrawn initially of £1,860. Sam put in £2,000. And we had a cheque from another credit customer for £410. So we now got £550 in the bank account. Now the total of our current assets, we add them all up together, and we get £38,580. Now current liabilities, because we've got more than one, we've got trade payables, and we've also going to have the bank loan as well. They're going to go in the first column here. Right, trade payables comes directly from your list of balances. So trade payables, here we go, it's 26,780. So it's 26,780. £26,780. Now the bank loan, we've got some works on the bank loan. And the bank loan, we were told in the question, the information, the bank loan, 0.7. One half of the bank loan is repayable in the year ending 31st of March 2014. So that's the next year, so that's the next 12 months. So it's going to be repayable in the next 12 months. That proportion is in current assets. And then the remainder will be in current liabilities. The remainder will be in non-current liabilities. So one half of the bank loan. So the bank loan, if we go back to the information at the top, was 2,450. So it's going to be 2,450. And we're going to divide that by 2. So 2,450. And divide by 2. We will get £1,225. That's going to be the same in your non-current liabilities as well. So let me put that down there at the same time. Okay. Now my total current liabilities then is going to be the 26,780 trade payables plus the bank loan repayable in the next 12 months of 1,225, give you £28,005. Now my net current assets is your current assets 38,580, take away your current liabilities 28,005, giving me £10,575. So that's our net current assets. Now we need to combine that with our non-current assets. So we're going to have 10,220 plus the net current assets of 10,575, giving us £20,795. Now, if there were no non-current liabilities, that would be our net assets. But we do have non-current liabilities here. We have the bank loan. And that's going to be the 2,450 divided by 2 of 1,225. Now, let me just put it in brackets so we don't get confused. So we're going to take that away. So our net assets now will be the £20,795, subtract the £1,225 to give us £19,570. Right, now we've got a bit at the bottom now, the finance by bit. This is your capital section. The opening capital, that we're given in the list of balances. So back to the list of balances now. All the way at the top now. Here we go, we're given capital. So the capital in your list of balances is always your opening capital. It's £11,060. Now, capital introduced, if you remember, Sam introduced some money. Now, that was in the additional information. If I remember correctly, I think it was £2,000. Let's just check that. Yeah, point 8. Sam introduced £2,000 into business bank account from his personal savings on the 31st of March 2013. So now I'm going to add together the opening capital plus the capital introduced to give me £13,060. Now, the profit for the year, that comes directly from our income statement. So going back to the income statement, and our income statement, we had a profit of £36,440. So I now add together the capital and the capital introduced of 13,060 plus profit for the year of 36,140 to give me £49,500. Then we've got drawings. We're going to be taking away the drawings now. So the drawings were in the initial list of balances. So back to the list of balances now for drawings. Now let's find the drawings. Here we go, 29,930. So we're going to take away 29,930. So take away 29,930. That's then going to give us £19,570. Now that figure here, just let me highlight a moment. You want to check that's the same as your net assets. It's got £19,570. So if they are the same, it suggests that we've done the question correctly. If they are different, it means something is wrong. But in our case, they're both the same, so it's telling us we've suggested that we have done the question correctly. So that was a very long question on both the income statement and statement of financial position. I hope that you found it useful. And thank you for taking care to watching this video. And I shall speak to you next time. So take care then. Bye-bye.